this video, I'm going to cover the Visible Range Volume Profile tool, VRVP for short, and also cover the fundamentals and basics of volume profiling, what high volume nodes are, what low volume nodes are, what they mean contextually speaking, and how they can be used in an intelligent manner to formulate ideas. I've gotten a lot of questions and comments on some of my posts on Twitter regarding what the volume spikes on the right side of the chart mean. So we'll walk through all of that. If you're watching this video, I'd request that you subscribe to the channel and hit the notifications icon because all of this content is free, so I greatly appreciate all the support. Okay, so let's get right into it. This is an excerpt from Jim Dalton's Mind Over Markets. A trader has one job: to be an objective observer of the market. This means she or he should observe the story being told by the market as it develops vertically and horizontally. So this is the premise. We're going to use this really basic tool to kind of get an understanding of how the story is being told by the market. If you're looking to revisit these, you can also just go on my Twitter account and go to the highlight section. The VRVP indicator basically just calculates the volume profile within the visible range of prices that are being shown on the TradingView chart. What I will say is that I use these as general areas. If you're using TradingView, it's not as precise. I would recommend using exocharts if you're looking for precision because it's a professional software. If you want more content on exocharts, drop the feedback in the comments. What I will say, a great resource is my friend on Twitter, Luxury. So shout out to Luxury. Make sure to follow him and check out his content, as well as C2M Trading, C2M on Twitter. Both of them have templates and also break down how to use exocharts. It's a steeper learning curve, but it's more precise. Today we're just going to keep it to TradingView, and you can use this as general areas and to formulate ideas basically. Okay, so what are these peaks? We're going to call them high volume nodes. So these are the peaks, HVNs, and the low volume nodes are these troughs or gaps, so LVNs. The value area is essentially just one standard deviation of the volume that's being transacted in this visible range. So one standard deviation, if you're being technical, is 68.2%. We can round that up to 70%. The value area high and the value area low are the two levels that are bracketing this area. And the point of control is just the most amount of volume being transacted in that visible range. We'll go through some examples. The setup is fairly straightforward. It's not really rocket science, but we're definitely going to go through some examples so you can get a sense of how to set this up. So why do HVNs or high volume nodes matter? The market rotates between compression and expansion and vice versa. Most of the time is being spent in compression or what we call consolidation. So contextually speaking, high volume nodes are just areas that represent consolidation or balance if you're referring to auction market theory. HVNs are just areas that are considered to be fair prices, which just means that participants have allowed price action to develop for an extended period of time in these regions, which show that for this period of time, these prices were agreed upon by both buyers and sellers. Now, in simple terms, what this means is you can look at these areas as molasses or friction. When price approaches these areas or trades into them, it slows down, and they also act as magnets when going between high volume nodes and low volume nodes. So low volume nodes, once price traverses through these areas, they'll quickly navigate to the area where previously participants agreed were fair prices. So if price is approaching from above, you can look to these as support, and if price is approaching from below, you can look at these areas as resistance. In mean reverting environments, these areas can be looked to fade moves. In trending environments, you can look at these areas for continuation. Another quick excerpt from the Jim Dalton book. If price is accepted at a particular level, then the market will probably spend time trading there. Thus, past high volume areas should be viewed as potential support, resistance points, and may offer a period of limited risk for trade entry and exit. So at times you'll see that these areas get tapped and then they provide some form of a reaction. So you can use this information to your advantage with confluence. Moving on to low volume nodes or LVNs, just as HVNs create areas where prices slow down or there's friction in these areas, LVNs basically create the opposite impact. So if price starts penetrating significantly into these areas, it traverses through with speed. And you can look at them as air pockets or air gaps or low gravity areas, whatever you want to call it. This basically happens because there's little to no value established. And what this translates to is that participants have little historical reference or bias in terms of what it means to trade into these areas. You can look at this as no man's land, and this is where aggressive positioning has stepped in to push price through these levels. So once price starts trading back into them, what happens is like you have a bunch of stops here as well as people's entries that have entered into these aggressive aggressive moves, and that position unravels quickly once price trades through these areas. An analogy is you can look at these as a balloon. So if you imagine a balloon here, you could see that the first tap provided some form of resistance between these two, or sorry, support between these two areas. And once price moved away and started coming back into it, it basically went through the entire area without any friction. So if you think of a balloon, when you try to poke it with a pencil, it'll offer some resistance, and once you poke through it far enough with the pencil, it'll basically pop the balloon. And that's how you can kind of view these areas. So to quickly sum it up before we move on to some examples, what is the use case of HVNs and LVNs? They provide useful reference points that enable traders to visualize potential future activity. The importance of such reference point lies in the detection of market change. By monitoring activity around high and low volume areas, a trader can determine whether or not directional conviction has changed since the area was formed. Through the detection of fundamental change, traders can better manage their risk and identify areas offering favorable trade location. Okay, so these offer areas of interest. High and low volume areas do not represent mechanical trades. They do, however, provide useful reference points that enable traders to visualize potential future activity. Okay, so that basically covers the technical aspect of things and what they mean. What we're going to do next is quickly walk through some examples on Bitcoin. In terms of setting up the visible range volume profile tool, you could just go under indicators, type in visible range, it'll pop up. You can double click, and you can adjust the row size, which will basically change the fidelity of the volume bars. I have it at 500. You can play around with this to see, if you want something that's more refined or coarse. Value area volume, you could change this to be 68, so it's more precise. And then if you go under style, you can have it so that it shows value area high, value area low. You can also view the POC and all that kind of stuff that we just walked through. And the visibility, you could change this if you'd like, depending on your preferences. So these can work on any time frame, and I'm going to demonstrate just that. This is a 12-hour chart on Bitcoin, and basically the idea of this works the same way. So last year, we had this period of prolonged consolidation between basically the beginning of March to the beginning of October, right? So you had this prolonged range. You can see this as an area where there was a significant amount of volume developed, and you see this effect where there's these rotations between this value area. So what happened once we broke out of this? The longer the consolidation, the more meaningful that range becomes, and the more meaningful a breakout from this range becomes. So what followed was an aggressive move or imbalance into this area here, right? This is what took us up to 110 in early January, and then you had this period of consolidation here where price was basically chopping around this range. Now what happened after this range was lost? You can see we discussed the importance of the low volume node. What happened was when price started trading back into this area, because there was lack of value development, it started trading right through, and there was value that was being developed here for a period of time, basically filled in most of this gap, as you can see here. And what happened was once the auction was completed here, there was some chop, and people determined where price was expensive, where it was cheap. It broke back into this value here and rotated to the other side. So like practically speaking, once you saw this breakdown of this consolidation, you could have had that idea of either playing the downside on the retest of the low side of value, and then understanding that this area, it has a lack of value development, so price can trade through to the other side, and it might be a while before participants determine what the next move is. So dropping down to the 4-hour chart, using the same principle, we had this area of consolidation. See, this is high volume node. You had this aggression that pushed price out of this, and you had this period of consolidation of like 10 days. This was in early May. Another aggressive move, rollover back into this area, and you can see as price approached this area, it started losing momentum. We discussed earlier, high volume nodes start acting as molasses. So the velocity of price traversing this area started slowing down. There was another attempted break above, which failed, trading back into here, and you could see that price slowed down once again after trading into this area. So dropping down to the 1-hour chart now, same principle. You had this period of consolidation. This is the fixed range volume profile tool, by the way. If you would like a video on this, I can do that as well. It's not really all that difficult, so I can cover this fairly quickly using this as kind of like the basics. So after this consolidation, attempted breakout, rollover back back here. And again, just showing the slowdown into this area of the high volume node. So how can this be used? I recently just posted something. If you want to keep it simple, on a breakout of this value, and if there's aggression, depending on what type of participants are showing aggression, you can kind of formulate your bias towards the upside. And on a breakdown of this area, if this turns into resistance, there's this gap down here where there was a lack of value development. You have this low, so this low can potentially be taken out. And since this is an area where there wasn't much value being developed, all of this is fair game, right? So this is how you can use these as areas of interest or to develop bias for your trades. So I hope that was helpful. Please provide any feedback, anything you'd like to see, and we'll see you in the next one.